to the Real Investment Show. I'm Rich Rosso here with Danny Ratliff. You may have heard the commercial. I always hear the commercial for Specs because that's my favorite place. But this is for the retirement right lane. So this is our most comprehensive retirement preparation class, but now webinar. Those are for pre and new retirees. So we talk about Social Security, Medicare, tax-friendly retirement income, realistic retirement income strategies. Now, this is Saturday, August 8th. I will tell you, your butt's going to hurt in the chair because this is a 9 to 11 a.m. event. But it's important, especially during market volatility, the pandemic. We need to help you understand how a paycheck is going to be generated. See, and I just spoke with someone yesterday about this who listens to our show. Hi. The financial services industry has geared for a wholesale accumulation mindset. They only talk about how to accumulate dollars. Every downturn is a buy. But you have to remember, if you're going to recreate a paycheck and you want to withdraw a fixed amount from variable assets, something doesn't sit right with that, okay? You are going to need to adjust, possibly, those withdrawal rates. So if you were going to say the rule of 4%, which is very popular in the brokerage industry, of your retirement assets to create a paycheck, and you might have run a retirement plan last year that said, woo, I have a 99% chance of success of not outliving my money based on my broker's plan. And now I run my plan and I'm at 55%. What has to give, Danny? What has to give is the distribution rate that you're using or the fixed rate that your advisor told you would never need to change. And that is going to be a harsh reality for many retirees right now. So Wade Pfau, who I love, he's a great retirement income guru, said, I think the 4% rule is going to be closer to 2.4%. Wow. If you haven't run an analysis to incorporate that in your plan, you have to scramble around in your household to figure out how you're going to cut your withdrawal rate for your lifeblood, your income, in half.
Yeah, this is huge. I mean, think about that. You go from 4 to 2.4% from an expectation perspective. I mean, you're almost cutting that in half. And I don't think most households are prepared to do so because we've been taught and ingrained for so many years that 4% is the rule of thumb that you can use, and it is the golden rule. And unfortunately, we've known that that's not quite the case. So you have to think about a couple of things. So sequence of return risk, so that variability of returns. If you look at a geometric return for the S&P 500, I can't remember the exact so some of that data we were looking at, Rich, was about 10% over the last some odd years. And the issue is that many people, or planners even, will benchmark your portfolio to that. But let me ask you this, and think to yourself, how many of you right now are invested purely in the S&P 500? How many of you have never sold? And how many of you are taking distributions? Because I think that's huge. The distribution aspect of it, if you're down 35% in March, now pop back up. But what does that look like? How does that impact your overall return when you start to see that variability?
What's interesting, Danny, is we've been writing and talking about this for years. Mm-hmm. It took the pandemic to get the industry thinking about it. So Michael Fink, he's director of Wealth Management Certified Professional Program at the American College, right? And I follow the American College quite a bit for their advice and their knowledge. This is what he says. I wish I could have phrased it as well as he did. The traditional 4% rule is a fluke of the United States in the 20th century. Failure to adjust one's spending each year in retirement hasn't worked well in other countries, and it might not work well anymore in the United States either. This is something we have been talking about and writing about since at least 2016. When we run plans, we incorporate this and we talk about this. We talk about this, and we have a couple of charts in our retirement right lane that show you to take a stable income from variable assets intuitively doesn't make sense. You went through the greatest bull market in history, so 4% worked, and then the rules never changed. The rules should have changed after the financial crisis, but it took this to make the industry better for you. So you have to look at spending flexibility, conservative spending. I am thankful, so thankful, that our plans, our retirement plans that we have run for our clients here at RIA are still in high probability of success categories because we have looked at valuations and adjusted down returns. We have talked about flexible planning schedules from withdrawals and shied away from the 4% rule. In my book in October 2012, when it came out, I wrote the 4% rule is a sham. But it took all this time, Danny, to finally turn some of the better thinkers out, like a David Blanchett at Morningstar, and Michael over at at the American College, Wade Pfau. These are, for us, our seminal, advice providers, and they've been really good at going this direction. But now they have gone over. They are there.
Well, and these guys are more academics, right? So these are guys that are behind the scenes, that are they're running numbers, looking at simulations, and engineering all the data. I'll be more impressed when I see the big institutions start to disseminate this information as well.
I think this is where it ends.
You think this is where it ends? It doesn't go any further?
I don't think any large big box brokerage firm is going to stray from the 4% rule.
Right.
I hope you're right. I hope you're right. This is where, if you do have, or you're taking advice from a big box financial firm, you want to bring up this 4% rule. Let's say some of the leading thinkers in academics are saying it's a sham. It may not work. You need to be flexible because these are variable assets. They go up and down. You want stable income. You maximize your Social Security. You do that properly. And you're lucky enough to have a pension, right? More and more. I admire all of you who have pensions, don't you, Danny?
Oh yeah,
yeah. You're. That's great. More power to you. Or you need to recreate your own pension with the use of annuities that provide income streams for you and your spouse for life.
That's a four-letter word for many.
Well, it is because we always see annuities are sold.
That's right.
They're not planned.
Well,
annuities, you may or may not. I spoke to someone yesterday that I said, because now I'm seeing people bring up annuities to me.
Yeah.
And I'm like, you know what? You don't need one. Only because you, with your variable assets and the way we've stress tested this, we can adjust your withdrawal plan and your reasonable expectations and what you've built. We can lower your... Matter of fact, a lot of the plans I ran last year, Danny, were based on a withdrawal rate of about 3. Okay? So when someone says, do I need an annuity? I'm finding more and more people are starting to look at that because of the downside risk. And I'm worried that a whole new generation of investors are going to be sold annuities that may not be proper for them. When someone offers you an annuity, you have to say, well, how do you know my whole situation to even think that an annuity is right?
Well, that's an issue too. So many people have a hammer, everybody's a nail. And that's a big issue. Now, the other issue is there is actual planning software out there that will give you you may feel comfortable because it comes out of a plan, but it's designed to sell you that annuity product.
You mean it all ends in an annuity?
It all ends in an
road
annuity
ends?
every time. Yeah, and so we do have to be cautious with that. You know, when we say it has to be planned for, not sold, we mean holistically. You have to take the big picture approach. And so this is why it's so important. So, you know, going back to the distribution strategies, Rich, this is why you have to take into account, how do you accumulate? What's your accumulation strategy? What does that look like? How do you retain that flexibility so you don't get additional Social Security taxes, Medicare surcharges, so you're not paying more to Uncle Sam in your retirement and you're not in a higher tax bracket, because that may be coming.
That's right. So you might not only have to adjust your retirement income, you might have to adjust your financial plan return expectations. And we're going to talk about that when we return. The Real Investment Show on 700 KCV, the voice of Texas.
Get daily investment news you can use, delivered at the speed of the internet. Sign up for the Real Investment Report now at realinvestmentadvice.com.